to attend. So that right away is going to be part of your success story as you're on this college journey. So I'm really excited to spend some time together with you guys today. Get comfortable, make sure you have something to drink, relax. Let's have a really laid back time together. Um, and I hope you have some takeaways. I'm going to share an agenda. We will have some Q&A after the presentation, and I'll leave some time in between for questions as well. And let's go ahead and jump in. And as Elsa just mentioned, this is the time. This is the time to think about credit, to think about planning your future. And of course, finances and freedom with regard to your finances really plays into it. So I'm going to ask you guys something. Just think about this, or you could use a show of hands if you want, or not. But when you were in high school, before you started college, you were in high school, a senior maybe when you started college, when you're at the airport, maybe Target, and you'll see kiosks offering credit cards. And maybe somebody approached you, maybe you signed up for a credit card. Um, it was so exciting. Like, oh my gosh, I'm old enough now. I'm 18. I could apply for credit. I might not have cash. Who uses cash anymore? I might not have money in my, on my debit card, but I can use credit. And if you're able to, by a show of hands, can you show if you have a credit card? And if you can't, that's okay. Okay. All right. Excellent. Well, some people do. Okay. Appreciate that. And, for those of you who have a credit card or are thinking about it, sometimes we can get caught up in the excitement, but we don't always know what goes into it. And that's what I'm here to do today, to answer questions, just to give a high level look at what credit is, why it's important. Credit scores. You hear credit scores and interest rates. Well, let's find out. Let's talk about the correlation of the two. There's some pitfalls, and then we'll have some, just open it up for question and answers. Okay. So without further ado, let's jump in and let's start the discussion. Okay. And I'm a big fan of keeping things simple. Um, I'm long-winded, I will tell you. It's a New York thing, but those of you who have worked with me know that. But I'm also a real fan of back to basics, keeping it simple. So I've tried to do that in today's presentation. Okay. So what is credit? It's when we borrow money with the intent or the agreement that we're going to pay that money back. Okay. And the way we utilize credit is reported on a credit report. Okay. It tracks how much we're borrowing and how we're repaying the funds that we've borrowed. And the result of our activities reported on our credit report results in a credit score. Okay. There are different algorithms that are used, and we'll go into this a little more later on. Okay. And it's so interesting because many people think, gosh, I don't want to deal with credit. It seems overwhelming. I'm just going to pay cash. And many years ago, okay, that worked fine. But the world is so big now and so complicated that credit is more important now than it's probably ever been. Okay. And it's not really hard to understand. And once you get it and you start using it, you get more power. Okay. And actually, we've set it up so I do have Q&A at the end, but if you have a question, you can write it down and save it for the end, or you could just raise your hand or type into the chat your question. So we'll see how that works for everybody. Okay. All right. Why does credit matter? Believe it or not, you go for a job, many times they're going to run your credit. You go to get an apartment, a landlord wants to be confident that you can pay the rent and they're going to run your credit. You want to get a car. Maybe some of you already have one and you've been through this. Went to get a car and they're running your credit. And this all impacts you because depending on your credit score, you may be denied an apartment or you may have to leave more of a deposit or pay more. You might have to pay more interest rates for a car loan, or you may be denied a job. So the end of the day, the higher your credit score, the better you're going to be. And we'll jump in a little bit to see what makes up a score, and we'll talk about that for a little bit. Okay. Oh, before I go further, again, raise a hand if, I mean, you're here today, so obviously you'd like to learn more, but raise a hand if you really don't know about credit and this is your introduction. Okay. Okay. And then maybe some of you know a little bit, but it'll be nice to get into it a little more. Okay. So the basics of credit scores. They typically run from a 300 to an 850. And of course, the higher the better. Okay. Your credit score, it's a snapshot of your credit worthiness. It tells people who are considering loaning money to you how high of a risk you are. If you have a good credit score, I might be more likely to lend you money because you've shown that you pay back your debts. Okay. Excellent. And there is a range, as you can see, and we're going to break that down. Okay. Okay. A lot of information on this slide, but let's talk about it for a minute. Okay. FICO scores. So back in the day, think when pioneers were coming out west and they were coming just to start fresh. And let's say it was a man and a family. So the two partners, their children, and they have a plot of land, but that's it. They've used all their resources to come across the country and claim their land. So they go to the local grocer, and the man might say, I'm a farmer, I'm new to this valley. My wife needs fabric to make clothes, some grain to make for food. We need some lumber to build a homestead. And then I need some equipment and maybe seeds so I could start farming. So the grocer has to determine, I don't know this guy. Is is he going to pay me back? So back in the day, they looked at other things. Communities were very small. So they looked at, does the guy's wife seem happy? Okay, she looks happy. He probably doesn't beat her. The kids look clean. Maybe I see them Sundays at church. I'm going to invest in this man. So the grocer gives him the things he's asking for, and they make an arrangement at the end of the year or the farming season. The farmer's going to pay the man back. And he does. So now he's becoming credit worthy. The next year he pays back either in money or in crops. And he says, well, now I want to make my house bigger. We've had another baby and I want to expand and get some more equipment. Because the farmer has showed his worthiness, the merchant is more willing to extend service. Okay. So that was fine for a while. But as more people moved into town, banks were established. And instead of people building their own homesteads, maybe they want to buy a house. Well, how does the bank or the financial institution determine an applicant's creditworthiness? Well, there was a Mr. Fair and a Mr. Isaac, hence FICO, Fair Isaac Corporation, and they came up with a system, which we're going to talk about, and an algorithm to determine someone's creditworthiness. Okay. There's different things that are factored into the algorithm for your score, and it depends on who's looking at the score. So there's different versions of FICO. A landlord might look at a simple version. A car dealership is going to look at a version that has more factors incorporated because you're borrowing maybe $30,000. And a home lender is going to incorporate more factors into your credit worthiness because you're probably looking to borrow hundreds of thousands of dollars for a home. Okay? And your your FICO score, because you have, well, what is it, right? Where does that number, what happens to that number? The number is the factors that determine your credit score or what creates your credit report. And there are three major credit reporting agencies, also known as credit bureaus. They're Experian, TransUnion, and Equifax. And they're private for-profit companies, and they report our credit profiles. Okay. And we're going to take a look now with the next screen and the one after that and talk a little more about your credit score, and then we'll talk about your credit report. But I want to stop here for a second and ask if anyone has any specific questions regarding FICO and your score with regard to what we've talked about so far. Okay, looks like we're good, so we will continue. And you can also see down here on this little chart, you know, less than a 580 credit score. It starts at 300. It's a pretty low score. So if you had, let's say, a 400 credit score and you said, Amy, can I borrow $1,000? I would probably want to look at your credit and see how much of a risk you are. And this would show me you're a poor risk. So I might say, no, I'm sorry, I can't lend you the money. Or I might say, sure, I could lend you the $1,000, but it's going to cost you an extra $500 in interest because I'm taking a big chance on you. The other side of the spectrum, if you will, um, if you have over an 800, you're exceptional. Wow. You betcha. I will lend you the $1,000, but the interest rate I might keep really low because you are a low risk and I'm going to get my $1,000 back. I feel secure about that. It's still a risk because life happens. Okay, someone asked about LexisNexis. There are different places where you can get your score, and we're going to talk about it some more. But the FICO score is the one that 99% of lenders look at. And we'll go into that a little bit further. That's a great question. Okay. All right. So what makes up our score? I'm going to give you a visual in the next chart, but this is very simplified. The biggest part, think of your credit score. It'll be easier to see in the next picture, but it's like a pizza pie. And it's it's divided into 5 pieces. Some are bigger than other. So the biggest part that makes up your credit score pie, if you will, is your payment history. And the takeaway, pay on time. When you pay something late, think about it this way. I lent you that $1,000 and you were going to pay me $100 a month. I didn't get that $100 from you yesterday on October 1st. I could be losing out on money because I was going to invest that money. You're going to have to pay for that, and you're going to have to pay a late fee. And if you continuously have late payments, you pay things late, your score goes down and you become a higher risk. So the number one thing you want to do is always pay your bills, your debts on time, okay? Before the due date. Okay. The next really big piece of the pie is the amount you owe. It's also known as utilization ratio. How much of your available credit you're using. So for instance, you get a credit card and you have $1,000 credit limit. Technically, you can charge that $1,000. However, you're maxing out your limit because you're allowed to charge $1,000 and you went ahead and charged 1,000. And even if you pay that back immediately, or when your bill comes due, the folks at FICO or the folks that determine your credit worthiness or the lenders say, Amy Martin had $1,000 limit. She just bought some new furniture. She bought a new couch. She spent $1,000. She's always paid it back, but because she's used all of that limit, what's going on? Why is she relying on credit? Or what if something unforeseen should happen? What if she loses her job? Heaven forbid. I don't want to put that out in the universe. What if she loses her job or gets sick? She might not be able to pay us back. But if Amy keeps her credit under her utilization limit under 30% or better under 10%, Amy's a lower risk because even if she loses her job or gets sick or something happens, she's not relying on credit. She's only using under 7%. So she'll probably be able to pay that back. That's a lot to digest. We'll talk about it more on the next screen. But does anyone have questions about that so far? Okay. And if I'm missing something in the chat, if I don't see it, feel free, Elsa, to let me know. Okay. Then there's three little pieces that also impact your score. Oh, we're not ready for that yet. The length of history, which is the amount of time your credit card's been open. Okay. So the longer it's open, the more history you've built up. Okay. So the older, the better. And then that makes up 15% of your credit score, or it impacts 15%. And then the other two pieces of the score are small. They impact 10% each of your credit score. One is new credit. So, how many times are you applying for credit? So you go to Target, you apply for their credit card. You go to Best Buy, you apply for their credit card. You go to, I don't know where. Macy's, I'm throwing that out because I shop there. Um, you go to Macy's, you apply for credit, TJ Maxx, whatever it is. Each place you apply for is a red flag because they say, wait a minute, you're asking me, Amy, to lend you money, but I could see that you've just applied to 5 other places. What if they all extend you credit? If you're charging with other places, how are you going to pay me back? Okay, you're a higher risk. So the fewer applications you make for credit, the better. Okay. And the last one they look at that impacts your score is a credit mix. And it's very interesting. There are two types of sorry. There are different kind of loans. There are installment loans, and we'll talk about that more. That's like your student loan, a car loan, a house loan, where you pay the same every month. And then there's revolving accounts, and those are credit cards. And they're different every month because it depends how much you charge on them, how much you're paying back, so on and so forth. Okay. Your FICO score, and your utilization ratio specifically is based on revolving accounts, your credit cards. Okay. And we'll go into that a little more on our next screen. Okay. Oh, good question. I think I answered that here. Okay. Good question. So this is the credit score, just to give you a visual. Okay. So you can see that payment history is the biggest piece. Okay. And not only, here's something to consider. Always pay on time. Even if it's the minimum amount due, you've got to pay it on time. Okay. One time in all the years I've had my house, one time I've paid it late. I was I was traveling, I was in New York. It was over the holidays, and that December payment, I don't know, I just forgot, which I've never done. It cost me, and so the next month I paid twice. They didn't charge me a late fee because I have such good history. It cost me 100 points on my credit score. One late payment. Never, so if that could be avoided, that's what you want to do. Okay. So you can see that's the biggest thing. Do you pay your debts on time? And the other is the amount owed. Now, you can Google this. You can get probably over 1 million hits if you put in how much to pay on my credit cards, how much of my utilization ratio should I pay? Okay. How much of my available credit should I use? Okay. I have $1,000 limit. How much should I use every month? So you Google it and it'll say never charge more than 30%. And that is an okay rule. But to get the highest score you can get, they're really looking for 7 to 10%. So on $1,000 limit, that's 70 to $100, and you don't want to charge more than that a month. Okay, so that's food for thought. The nice thing is, if you keep it really low and you don't put much on your credit card, if something happens, you got a flat tire, something pops up, maybe there's a concert you really want to go to and you don't have the cash now, but you want to buy the tickets, you can put it on your credit card. You just want to be smart and plan so by the time the bill comes, you have the money to pay that. Okay. Minimum payment is acceptable because you're paying on time, but then you're going to pay interest rates. So you want to make sure you could pay in full. I will tell you my credit score, I just got an updated one, and it's an 834, which is exceptional. Okay, I'm proud of it. So I tell everyone because I'm excited. And even with that one late payment, because it was like 6 years ago. So it's your newer activity that impacts your credit score the most. Okay. I was going to tell you something about my 834, but I forgot now. So we'll come back to it if it was a good point that I really need to share. Oh, I know what it was. Okay. As I look, I've been in this industry 18 years, and I think I started with like a 740, 760 maybe. But I was like, I'm learning so much. Let me play around with it and see how it impacts my credit score. I had one credit card. So what I did is every month I used the card, but I would just put like milk and bread. And so I'd get the bill. I mean, now it's through my app, but I'd get the bill. It was $10 a month, and it was easy to pay. And over months, they could see, wow, Amy Martin has a, whatever credit limit, and she charges $10 a month. That helped to better my credit profile and increase my credit score. Okay. Something interesting, credit mix. This is interesting. So as I mentioned before, they like us to mix it up a little bit. Installment loans, like a student loan or a car loan, and then have credit card accounts and see how you manage both. What's interesting is, and when you could see a lot of bank apps will show you, I use Chase, I have, the app, and we'll get back to that auto pay. That's a great question. And when you see the credit score pie, like in your app or from your bank, it'll show your rating. Like, and I have all A pluses, but in credit mix, I have a C, but I have an 834 credit score. So I looked to see why, because I know why, but I wanted to see if they were thinking the same as I was. And it's because I don't have any loans. We don't have a student loan for my son, and I own my car. So all I have is my house, and I still have a mortgage on my house. So it's interesting. I will say this. This credit score, this credit reporting and credit worthiness, it is a game that we didn't opt into play. It wasn't designed for the consumer, but it's so impactful for our lives. We've got to know as many of the rules that we can so we could be smart. And it's achievable for everybody. So that's the really good news. Knowledge really is power. You do what you can when you can, but today we're learning. Okay. So I just wanted to mention that to you. And then somebody asked earlier how often you should apply for credit. So you can see when you apply for credit, it stays on your credit report for 2 years, but it only impacts you for 1 year. So let's say you just love Target and you're like, I'm getting a Target card. Okay, great. And they approved you. That's great. Maybe wait at least 6 months so you can start using that card and seeing how responsible you are with it before you apply for another card. If you're denied, you probably also want to wait. So it doesn't look like, oh my gosh, I need credit so badly. They okay, want to know that you can manage your finances. Okay. Um, so we're going to stop here, and there were some questions, and I'd like to address those so can we, if I could see them. Let me see if I go into chat, if I could see those.
I can read them to you too.
Okay. Oh, I think I have it now.
Oh, perfect.
Okay. Let's see. Oh, if you have auto pay is great. Okay, that's very smart. Just know if something happens in the computer system, the technological piece that transfers that auto payment from your bank to whoever you owe the money to, you didn't do anything wrong. You have it scheduled, but if for some reason that's late, it's on the consumer and it could be reported. So it's great to use auto pay, but just make sure you check and make sure that the payment went through. Okay. Fixing credit card debt, that's another topic. So that's actually what I do. But if we have time, we'll talk about that. Okay. And I think I talk about it a little bit in the presentation. Okay. These are great questions, you guys. I love it. All right, let's get my mouse back where I need it to be. Okay. The next thing I wanted to mention, I don't know what happened. Okay. So just as an FYI, so now you're establishing credit and you're getting a credit score. The credit bureaus, as I mentioned earlier, Equifax, Experian, and TransUnion, they produce your credit report, and they get the information from furnishers. Furnishers provide the information to the credit bureaus. They pay. So that's one way the credit bureaus make money. And it's usually your bank, whoever you owe money to, sometimes landlords, they're the furnishers. So I just wanted to let you know that. Okay. This is some more information. We won't spend too much time, but it's FYI, and I think it's important that you should know this. Okay. Let's say, like me, you forgot to pay your mortgage. Don't ever do it. Learn from Amy's mistake. Um, but you see, even though I was late and I lost the 100 points, I got them back. Okay, so just so you know. Okay. When you first miss a payment, it's known as date of first delinquency, and it can report a negative item, and that's considered negative when you start missing payments. Okay. They can report on your credit report for 7 years. It doesn't have to, but it could. Okay. And that's important for you to know because there are repercussions for our actions. Sometimes life just happens, but again, knowledge is power. So once we're 30 to 90 days late, let's just say it's Bank of America. They'll report on that month you were late or the months you were late as a late payment. Okay, and that can impact your score. Once it's over, once it's about 120 days late, it's reported typically as a charge off. And what a charge off means, and this is just a little extra tidbits for you, okay? But what a charge off means is the company saying, Amy Martin's not going to pay me. So I'm going to let the IRS know so I don't have to pay taxes on that money because I never got it from Amy. And I'm going to charge it off. Okay? It doesn't mean you don't owe the debt anymore, but it means the company doesn't expect to get that money from you. Okay? After a charge off, they might sell it to a debt collector or assign it to a debt collector. And now the debt collector might try to get the money from you. The debt collector or the debt buyer might have paid pennies on the dollar for the debt that you owe. And then they can try to have a judgment, which is a lawsuit, and it goes to court to try to get money from you. So that can be scary, when you look at that, but it can be prevented if we are careful about what we're charging, how we're charging. You want to make sure you'll be able to pay it. And that's why it's very safe to use a strategy similar to mine, milk and bread or whatever's a $10 purchase a month, that's safe. Years ago, we would tell people a tank of gas, but we don't do that anymore because gas is expensive. And you could start getting in trouble that way if you put all your gas on a credit card. If you have the money, go for it. But if not, $10. Okay? All right. Okay. Now, this is fantastic and this is important for you to know. And everyone wants to make a notation. Annualcreditreport.com. Okay? Every one of us, every consumer can every 12 months for free get a copy of each of their credit reports. Okay, go to annualcreditreport.com. It's it's federally mandated, and so it's wonderful. This is something in place to help consumers. Everyone should do that, and you could space it. So every 4 months, if you want, get a different bureaus. Because sometimes there's different things reported on different credit reports. Okay. And I'm happy to talk more about that, but I'll save that for another time. Okay. But annual credit report, if you can get a free report, it's wonderful because it allows you to know what's on your report. And the reason I say that is because sometimes on reports, there are things that are inaccurate or unfair. Okay. or unsubstantiated. And as a consumer, we want to make sure everything that's reporting is correct. And here's some examples, okay, to look for. It's very common to have a mixed file, juniors and seniors. Oh, shoot. My dad's information is reporting on my credit report. I'm 19 years old. I never had a bankruptcy or whatever dad, has going on, which is fine. Um, so that happens often. Okay. There are so many consumers in the nation that how many Amy Martins are there? So there can be just mixed up files. They put someone else's information on my credit report. I need to make sure because if I go to apply for credit and if I get denied, I need to know why. Okay, so that's important. It's a little, I hope you can see it okay. The other thing you want to look for, unfortunately, fraud and identity theft is huge. Your computer gets stolen, your phone gets stolen, you know, and that leaves you vulnerable for somebody using your identity, maybe opening up accounts in your name. Now, our financial institutions are fantastic. And typically, by way of a third party, they'll contact you or they'll send you an alert and say, like, Amy, were you recently shopping in Indiana and did you buy, $6,000 worth of electronics? Sure didn't. So there are red flags, okay? Um, but sometimes it doesn't get caught. And so if you notice there are accounts on my credit report, let's say for Best Buy, I've never shopped in Best Buy a day in my life. That's not mine. So that's something to look for, okay? I don't have the stats. I should have put them in here, but there's a huge percentage of consumers, huge, who have, you could Google it, who have errors on their credit reports. And that could affect our scores and our ability to be approved for credit. So just be an educated consumer, okay? And also sometimes there might be something on a credit report that is yours, like my late payment that I shared with you guys because it happens. Um, but it can't report more than 7 years. Okay. And so I think it's already been 6, so it should fall off soon anyway. Um, I put 10 years on here because certain bankruptcies can report for 10 years. You guys don't have to worry about that. You're just starting out and building credit, but it's good to know. Okay. Okay. And that is it for today. But before we jump into any more Q&A, because I've shared so much information, somebody asked about how to repair your credit. Okay, I guess I took out that slide. And credit repair, I will mention this financial group at the U. They have been so kind, the financial wellness group. You can meet with them. And then I come in once a month as well if you wanted to have a one-on-one with me to talk about how to repair your credit. And at my firm, because we really, I personally and us as a firm, community support is so important. So if you find yourself needing credit repair, we can talk about a no-cost credit repair for you, and I could talk to you more about it one-on-one because it is so important. Okay. And, sometimes maybe you're helping out your family. And so things are in your name and it's affecting your credit, and that's okay. It's all just called life. And so I'd be really happy if anyone wants to meet one-on-one, we can do that. Otherwise, I will open it up to questions. Questions, thoughts, a joke, a limerick, I don't know, whatever you have. This is truly a passion of mine. Sometime I'm going to fill the space really quickly. Oh, here we go. What happens when debt goes to debt collectors? Okay. So when a debt goes to a debt collector, technically, let's say I went shopping at Macy's, got a few new dresses, okay? And then I didn't pay Macy's. And Macy's was like, I'm going to charge this off. This consumer's not going to pay me. But Macy's doesn't want to lose all the money, so they sell the debt to a debt collector. Now, Macy's doesn't own the debt anymore. It doesn't mean, so Macy's doesn't own the debt anymore, and the debt collector can try to get that money. Okay. Technically, I don't owe the money to the debt collector because I don't have a written agreement with the debt collector. I have a written agreement with Macy's. Okay. So there are ways to challenge that. We certainly encourage people to pay their lawful debts. So let me see, added question. So technically, you still owe the debt. The debt collector can try to collect on the debt, but they can also put that on your credit report. And that's how it incentivizes consumers to pay it, because that could hurt you for 7 years and show that you didn't pay your debt to the original creditor, Macy's, and now the debt collector is trying to collect. So it can still hurt you. Whether you have to pay the debt collector is a little fuzzy. Not necessarily. But of course, if you don't, it tanks your score. It can hurt your score. Okay. Medical debt. Okay. Medical debt, that's an interesting one. And these are good questions because there's so many caveats. Okay. So this question is if something was done against your will. Okay. And without seeing the contract, if, was it a doctor's office, a hospital, did you sign giving permission? And then they ended up, removing limbs when you were like, I went in for a toothache. So that could be a whole different legal analysis. Okay. However, when it comes to medical debt, it sometimes it depends on the state, okay, how it's being reported. And medical debt, there was some talk, I think, back a couple of years ago, and certain things might have passed about reporting medical debt. Depending, I'm sorry, I'm kind of babbling a little bit. Okay, let me explain it this way. So we help different people in the communities that might need credit repair. Some of the people I work with, for instance, are survivors of human or sex trafficking and maybe domestic violence. Okay. And I'm mentioning it because, heaven forbid anyone has this in their life, but this is life sometimes. And so let's say a partner beat them up and they had to go to the hospital. They get care. Okay. So the hospital and the doctors, they deserve to get paid because they helped you, but you were victimized. So there are some rules in place to prevent those kind of things from reporting on your credit report. So it doesn't hurt your credit score, but you still might have to pay be liable for that medical debt. That help a little bit. That we'd have to dig in a little more. How many years can it take to build a score? Oh, you know what? For years, I was over 800 and I had one credit card. It's so tricky. And I didn't make a lot of money. I was just so good about only charging that $10 a month. Here's something. So, like I said, I did milk and bread and charged $10 a month. Okay. And then about, let's just say once a year, I would go back to New York. Actually, it was probably twice a year, me and my kids. And so now I changed my habit, and twice a year, I charge just say, $2,000 for plane tickets. Okay. And so I would put it on my credit card, and then I would see my score go down. And then I would get the bill. Let's say my score went down 15 points. And then I would get the bill for those tickets. I would pay in full. And now my score went up 20 points. It's interesting. It's always moving your credit score. So what happened was I had a certain spending habit and usage with my credit report, with my credit card. But then when they saw I spent a couple of $1,000, the powers that be at FICO say, wait a minute, what's going on? Is she going to start charging a lot now? Is she going to pay it in full or not pay it all? What's happening? And so they weren't sure, and I lost some scores on my credit report, some points. But when I paid it in full, I gained even more points. That's how this crazy world of credit reporting and credit scores work. We don't know all the formulas. There are hidden algorithms, seriously. You can Google it all, hidden algorithms, but what we do know, I've shared. Um, these are great. You guys are so informed. Um, so I think at the end of, oh, here's something else. Let's see how much time we have. A couple minutes, about 10 minutes. Here's something. If you have a credit card already, consider how often you're using it and if you're paying it in full every month. If you are, congratulations. Some people don't understand that until they're 30, 40, 50, 60 years old because no one teaches it to us. Okay. Um, if you don't have a credit card yet, that's something to think about. You're a student at the U, you can look into their student credit cards. Sometimes you even get, I don't know if I don't know which cards do it, but some student credit cards offer perks for good grades. So that's exciting, low interest rates. Sometimes there's no interest for the first year. So you could charge, pay it back, kind of feel it out as you're learning. That's why this is the time to learn about credit and start establishing. Another thing you can consider is two other things I'll share. One is becoming an authorized user. So maybe a parent, um, a trusted person who has very good credit, doesn't pay anything late, and they can add you as an authorized user. I've done that for my kids when they turned 18. I just called up a credit card company. I want to add these two. Here's their socials. They asked me, do you want them to have the credit card, a copy of the card? I was like, no. But they have credit. They automatically have the history of having credit because I've had this account open for years. So it's a start. So they started out with 740s, even though they never had a card yet in their own name. So that's something to consider. The other thing you want to consider is a secured credit card. And a secured credit card, you have to tie up some money. Typically, it's about $300. And you would go to your local bank or credit union and you give them $300 and they give you a credit card with a $300 limit. And as you use that card, they report that activity to the credit reporting agencies. And the longer you have it, now you're building history. Oh, Amy Martin has a $300 limit. She charges $10 a month consistently. What a responsible consumer. And it's called secured because if I max out and spend $300 and I don't pay the bill, they have my $300 tied up. So it's secure for them and it's a way for us to build credit. And sometimes after about a year, they'll offer it to be a regular credit card and they'll raise the limit. So that's something else to think about. Where to get the student credit card? I think you can go to the financial office and find out about that at school because I know the U does offer it, and I meet with many students who have their card. So you can find out about that. You could probably look online as well. And then you can look at some other options. Um, and specifically student credit cards and take a look and see what might work best for you. We have about 5 minutes. This was timed pretty good. Because there's so much to talk about. And you know what? I want to invite all of you to provide feedback because I continue to learn and grow every day. So if you feel there was too much material, not enough, it was presented in a way that was a little confusing, some other things you'd like to know about, please share that because that's how we all get better together. It's by sharing together.
Well, thank you so much, Amy. Let's give Amy a virtual round of applause. This was very informative, and like Amy said, yes, we send out like a 24-hour feedback survey that all of you will get. So please fill that out and then make sure that you've gotten signed in. We'll put the link in the chat again, but make sure you do that. And then yeah, we'll stick around if any of y'all have any last questions, but thank you for coming and thanks for celebrating College Financial Plan Week with us. Yeah, hope you have a good rest of your Thursday, and then next week is fall break, so have a good fall break as well.
Thanks for the invite and thanks for having me, everybody. Appreciate it. You have everything covered, Elsa.
Thanks everyone for coming. Well, Amy, that was awesome. Thank you.
Did you stop recording?
Oh, let me stop. Stop.